Okay, welcome back to Rockstock Channel. It is Thursday, July 24th, and we have back on the program two of our favorite analysts, TD Cowen's John Miller and David Deckelbaum. John is based in Washington, D.C., and covers all things U.S. government policy related, so we want to hear his views on Trump's big, beautiful bill and his various executive orders, which have strongly supported the critical minerals narrative. David is based in New York and covers specific equities not only in lithium, not only in rare earths, but also oil and gas names, so has great perspective for how investors are thinking about the shift in thematic investment narratives. David, when we met in 2021, around 2021, Cowen was an independent investment bank with intensive research focus, which had carved out a particular niche in sustainability and other clean investment trends. And despite COVID, those were very bullish times for many risky sectors, especially throughout the entire EV battery critical mineral supply chain. There have been a lot of tears since in the last 12 to 24 months, with many EV and battery bankruptcies and many SPACs trading at 90% down or more. But market sentiment has recovered strongly in recent months. It is currently risk on in the broader equity markets, and commodities of all types are getting strongly bid. Some survivor SPACs are now thriving, like MP Materials, trading at an all-time high. Its near 11 billion market cap has surpassed Albemarle and Alcoa. Titanium metal story Hyperion X is also at an all-time high with a market cap above $1 billion. And Talon Metals and nickel is at a 2-year high, while Seafloor Mining SPAC, the metals company, now sports a market cap of around $2.5 billion. As I've said for most of this year, 2025 is feeling to me like 2020, with the Liberation Day sell-off in March being a supply chain disruption event similar to March 2020's COVID. But by the summer and into the fall of 2020, the market sharply corrected upward, and risk assets of all types rallied aggressively. It feels like something similar is happening as Trump passed his big, beautiful bill and trade deals are happening. Foreign direct investment into the USA is picking up. Inflation seems under control. SPACs are back, and commodity equities are back. ETFs for uranium are up 47% year to date. Copper's up 21%. Rare earths, 33%. And gold is up 50%. And even lithium, the lithium ETF, is now up nearly 10% for the year. If we get interest rate cuts and a big trade deal with China later this year, we could experience another huge bull run like we did in 2021 and 2022. And yet, much of what I read and podcasts, which I consume voraciously following the clean energy and climate policy, is bleak, John. From an investment thematic perspective, sustainability, ESG, energy transition, net zero, the Green New Deal is out. But the age of electricity, physical AI, energy dominance, and supply chain security is in. Energy and Interior Secretaries Wright and Burgum are touting not just drill, baby, drill, but mine, baby, coal mine, and nuclear, benefiting uranium, and sinter, baby, sinter, mine to magnets through a game-changing Department of Defense and MP Materials deal, which we've talked about and written about quite a bit. So, John, it seems solar and wind and EVs are out, but batteries are still okay. What's your assessment of the net impact of the one big, beautiful bill on U.S. domestic demand for EVs, solar, wind, and battery storage?
Yeah, thanks so much, Howard. Great to great to be back. Thanks for inviting us back to have these conversations. And as you highlight, just an immense amount of moving pieces at this time period, right? And it becomes a challenge. Um, I would also agree that a lot of the narrative that you hear emanating from traditional energy transition voices that focus on policy tend to be bearish at this point, right? There's a lot of negative commentary, a lot of commenting on what the one big beautiful bill or Trump's tax bill, however you want to frame it as, does vis-a-vis the Inflation Reduction Act, right? And this step down in some of those narratives. Like, I think we're beginning to finally get past that, right? Instead of framing all of this as change, negative, headwinds, policy disconstructor, or volatility, I think we need just to recognize that the objectives of this administration are different, right? They are going through a very intense 6 months of coming into office, deploying their toolkits and pushing Congress to try and lock in where possible. So, as we tick through this, the one big beautiful bill is critically important. It's legislation, it's tax code, it's sticky, but as you mentioned, there's also just a range of executive orders. The administration is now well over 100 executive orders. And then there's a trade policy as well, right? And so these are kind of toolkits within the administration. So the objectives of the Trump White House, right, are energy dominance, right? That's a whole new narrative, right, which has transitioned away from energy independence. Still some questions about what that actually means on the ground. Is that an attempt to simply produce more energy? Is it an attempt to reduce costs? Is it an attempt to own all energy value chains or select value chains? Really, over the past quarter, we've seen, particularly from Department of Energy, a focus on the energy value chains they want to own, where you're hearing Secretary Wright now say things like, he's not an all of the above guy because all of the above is political. Right? So it's a really interesting statement. There's going to be winners and losers from a policy perspective. The One Big Beautiful Bill is a great place to start, right? So as you mentioned, solar and wind are impaired from a tax credit perspective compared to where they were historically. Energy storage kind of uniquely is not. And there's other aspects there too as well of producers of low carbon electrons. So geothermal, hydro, nuclear, those do well along with energy storage. And then on the manufacturing side too as well, right? All the credits in that space for advanced manufacturing credit, which is 45X, it has a reduction for time period eligibility for wind, but not for energy storage. So I don't necessarily frame it as like it's all necessarily bad. It's a restructuring of the environment, different phase out dates, different access requirements based on the supply chain. But those credits are still available, and there's going to be a lot of figuring that out really over the next 45 days as we get some implementation guidance. The critical mineral side, one thing I would note too in the One Big Beautiful Bill that is interesting is that the 10% tax credit for delivering processed critical minerals, right? That was always a component of 45X on the advanced manufacturing side. That now does have an expiration date. So that is a little bit of a change. Historically, under the Inflation Reduction Act, that was an unending tax credit. And the concept there was if it takes 5 or 10 years to really to go through the permitting, engineering, and startup process, this needs to be really long dated tax credit to reduce some costs and get to a place where 45X actually does expire. That does now have an expiration date. So we're monitoring that and seeing how that impacts some plans in this space. I think overall, though, like as you've mentioned, the executive order is looking at owning various different segments of the economy of the future, and then specifically the trade action right around critical minerals and around copper. They, that's the pathway this administration wants to take, right? As opposed to saying we're going to have really specific tax credits for XYZ technology. Let's throw up a very strong trade moat, right? Incentivize this behavior in the United States. And if necessary, possibly have DOE or DOD come in on top with direct financing, loan guarantees, or possibly even equity investments in firms that we think are strategic. So like I say all that, right? And we start with the conversation as the podcast, the DC narrative is negative, but there's a lot of really interesting things going on, right? And the last thing I'll say before we turn it back to other Q&As, like really in the past week, we've seen this administration hammering away at two very well attended events on artificial intelligence. So that's the data centers, that's the hyperscalers. And while the administration comments tend to focus on owning that technology as a narrative of the economic future, the power component behind that, the infrastructure component behind that, energy storage, natural gas, geothermal, and renewables in the near term, they're a huge part of that. And the administration's really focused on that in a way that even the Biden administration wasn't, where maybe they came at it from a top down 2030 greenhouse gas emissions reduction target. This administration is like, how do we get these activities up and running in 2026 so we can continue to lead our geopolitical rivals in this space? So lots of interesting things going on. Happy to unpack any direction there that makes the most sense.
That's very helpful. I mean, we've talked a lot about AI and the energy needs for that, and I've quoted repeatedly Next Era Energy, America's largest utility, which has nuclear, which has natural gas, but they keep arguing, the fastest and quickest to deploy units to the grid are renewables plus batteries. But you're not here. You're hearing, Chris Wright talking about, the clean energy, or wind and solar as energy subtraction, not energy addition. And today we saw, $4.5 billion loan guarantee for the Grain Belt Express, was nixed. So, and in the big beautiful bill, there were some, at 11th hour, they tried to kind of tax solar and wind. It didn't make it, but now there are rumblings that what they didn't get legislatively, they'll seek to stall, for solar or wind projects. So do you think Trump will continue to double down on these anti-clean energy policies in the context of the fact that for AI, the biggest utility is saying, we need this super fast?
Yeah, yeah, and I mean, NextEra, as an entity, is messaging that in a very sophisticated way and on a repeated basis, right? If you look at basically, I think it's the third slide of their earnings deck, they outline that as the waterfall. It's if you want to have power in 18 to 24 to 36 months, these are your options. Great, getting into the 2030s, back half of the 2030s, these are other options that are in play. One of the things that we do on a routine basis here as policy analysts, right, is always trying to unpack political communication, which is effectively noise, right, and policy direction, which is the signal. And you highlight a really interesting number of policy actions, right, that are mindful and we should watch, right. So the Senate did attempt to slip in basically an excise tax on renewables after the expiration of the clean electricity ITC and PTC, which are the historic subsidies for this space. But that didn't make it through on the other end, right? So there is a consensus within the Republican caucus that we can have technologies that we support. They are much more advocates towards traditional, yeah, thermal resources, natural gas in particular, layering in geothermal, layering in nuclear where that's possible, hydro in a footprint where it makes sense, and less supportive of alternatives. But that doesn't necessarily mean you need to like push down and produce negative policy for that space. So that's kind of what we're really watching. Like, is this administration going to bias federal policy towards the technology it prefers? That's one thing. But they are actually going to use the federal government to obstruct. And so, there is some obstructions that are out there that we think are mindful and worth watching. A lot of that's coming from the Department of the Interior, where they've basically implemented a structure where any permitting action involving transmission or renewables has become political, right? And for any sign off, any approval to move forward, it really has to get elevated up and through the cabinet secretary's office. So, that is obviously going to slow down projects. Developers have seen this coming. Activity on federal land has been difficult, even historically, right? In projects that move forward under the Biden administration, a lot of them were actually proposed in the Obama administration, right? So federal lands has always been a challenge, and you've seen developers decide to move away from that space. So we are watching this, right? I think the political communication from Secretary Wright, from Secretary Bergen, and obviously from Trump is going to be one thing, but are they really going to be pressing down and saying we can't do this? And our view is that in the near term, over the next 6 months or the next year, there's going to be a realization that politically, what sounds good can't be deployed in the economy because there's going to be impacts. Right? And maybe the last thing I'll say here too, as well, is that the political cycle is always a bit divorced from the economic cycle, right? So if you're a member of Congress on the House side in particular, getting a new project online, a new plant, new nuclear in the 2030s, that does nothing for you, right? You're looking at 2026 in November and a midterm election, right? So there are calendar dates here that are much closer, which require the technologies we have available at scale now. So that will come into play as we get into the back half of this year and really into 2026.
Okay, there was a lot. There's a lot of moving parts, a lot of things to kind of digest. I saw Jim Litinsky was in Washington at the All In podcast, their kind of summit
Mhm.
there, as was JD Vance.
Mhm.
Chamath Palihapitiya had invested in MP. David Sachs is the AI czar. This is the administration of common sense, or they advertise themselves as such. And they passed the Genius Act, for, I guess, cryptocurrencies, et cetera. And, so it's a tech focused administration. I mean, we, we will lose the AI race if we don't have enough energy. And, but again, it hasn't fully translated into, political rhetoric, right? And if anything, you're saying like this is also is supposed to be the deregulation administration, but you're saying that they're increasing regulation, reviewing of solar wind projects, especially on federal lands. That's something that we're very familiar with for federal lands for mining, but they should be kind of like approving everything, but they're not, I guess.
Yeah, I mean, there's some politics to that, of course, right? And there's the reflection of whatever the Biden administration did was a problem, so we need to flip it. And Howard, I know you mentioned Grain Belt Express and the loan guarantee there too as well, and it didn't particularly address that. I think that's an interesting example here too as well. Is like, we've been chatting about this, and we put it forward to clients really since November when Trump was elected. Like, really anything out of LPO, the Loan Program Office within Department of Energy, that's still sitting in that conditional stage. I think it's our view that, right, it's probably not going to move forward, right? There's going to be this presumption within the Republican Party, within Chris Wright's DOE, that these were all political decisions made by the Biden administration in the last moment on the way out. These probably aren't projects that are ripe for public subsidy, and so, like, our view is that these conditional projects are going to be rejected right through this administration. The timing of that's really the question. So we'll see these roll out over time. It's interesting you get a sitting senator really engaging on this project. This is Josh Hawley from Missouri. The other side of the story is, right, is that Missouri's Public Service Commission, right, the actual regulator who cites this project, that does the return on equity perspective from a state perspective, and the federal side at FERC. That project's been approved, right? So why are we even intervening on the federal side to have these conversations? And if it is really about financing, and we'll see if that project can go and find private financing to fill that gap. If there's really demand for the project, if there's really offtake, that project will go forward, and maybe that's a better place, right? You've sort of depoliticized this by excluding that federal loan guarantee, and allows the project to move forward on its own legs. You can argue like this is just commercial supply and demand. The project needs to move forward. It's not a federal government coming in subsidizing and picking winners and losers.
Okay. And that was a loan guarantee, not a loan. But it's interesting you say that conditional loan. The loan programs office, I understand they've laid off like 100 people, but there are some loans out there that haven't yet, been through for energy source minerals in the Salton Sea. I think that's a conditional loan. I would think, I don't know if he's going to support a California lithium project, but broadly, it's not all of those loans that were kind of rushed out. I mean, I know Jigger Shah and those guys did a very thorough job in all of those loans. Certainly on the critical mineral side. I don't know about elsewhere, but I
Yep.
presume
Yeah, I mean, absolutely
as
agree with
well.
that, right? They had a very deep due diligence process, or traditional financial due diligence process, and on top of that, a policy due diligence process. Just, the optics of the flow of conditional announcements, and even some final announcements in that last, we'll call it quarter of the Biden administration, is problematic. There's been significant restructuring within that office. To your point, there's been a number of employees that took the fork in the road. Some have been riffed, some have redeployed. So there's been a significant downsizing. That doesn't mean LPO goes away, right? Actually, within the one big beautiful bill, while some LPO loan dollars and loan authorities were rescinded on sort of like the alternative vehicle side, there is this new energy dominance loan portfolio structure, right? Which is a bit broader. It could include some traditional thermal resources, a lot more in power and power infrastructure. So I could see that popping up potentially in mining, could see that popping up potentially in trying to commercialize new nuclear, which is clearly a priority for this administration. So they will be active in that space. It's just, again, anything that's sort of sitting still in the conditional phase has this sort of Biden era stamp of approval, and what we've seen from this administration is that that's sort of a red flag, something they're going to focus on, and there's certainly risk until it's finalized.
Right. Okay. You mentioned, I guess this 10% credit in the
Yeah.
ATM 45X has an expiration date. What's the expiration date?
It's a 3-year step down that starts in 2031, and the last year of payments is 2033, where you get 25% of the credit. So there is a step down in that structure.
Okay, because a lot of the companies can't take advantage of that, like if their project isn't going to get up until 2030.
Yep.
But okay, but there has been a shift, right? So you said that credit was there to support anything, all the above, right? Instead, they've kind of like replaced this, and they've, in an industry that's not supposed to pick winners, right? The DoD has said, okay, MP materials, you're going to be a winner, right? So that was rare earths, very, specifically. Um, I guess, do you see, John and David, I'd like you to comment on this because I've made a comparison of that DoD, like the support of the DoD of MP materials to the support of the DOE, to Lithium Americas, and how that dynamic, they're very different kind of structures, and they've had very different impacts, on the stock of those two companies. But I guess, John, could you see similar floor price mechanisms like the DoD used in MP being applied to U.S. lithium assets, graphite, nickel, titanium? Are there any metals in particular that you think would be next after rare earths?
Yeah, I'll obviously let David speak to the specifics of the MP deal, but what really stood out to us was that offtake agreement, right? Basically setting a floor price, upside, optionality there if the wholesale price moves forward. But I mean, this is a well understood phenomena within the U.S. government at this point, from DoD to USTR, which is the trade representative, commerce, and the executive office, is that whenever a non-Chinese mining project begins to move forward, you see a response from the Chinese dominated side, either the mining or processing side, to lower the wholesale commodity price, right? And that makes the project basically uneconomic, and then you end up in the same situation where you were on the other side of that with centralized control from one or two strategic players that are outside of the U.S., outside of what we consider strategic geopolitical allies. So that is a really unique component of that. That's not a new concept here in DC. It's kind of been kicking around for about 3 years at this point. You've seen Democrats express some interest, Republicans express some interest. The challenge has always been it's kind of came from Congress, and Congress would need to appropriate the dollars, authorize and appropriate the dollars, and we're in an environment where that's hard. I think you can be constructive that we may see more of this going forward. So within the one big beautiful bill, there's $7.5 billion that's it's obligated and authorized to the Department of Defense for this space. So there's 5 billion for what's called the Industrial Base Fund, 2 billion for a national defense stockpile, which could be exactly what we're talking about here. It's like we want to procure these either process components or finalized inputs. And then there's $500 million for a new critical mineral loan fund, which could be leveraged up to $100 billion in project loans and guarantees. So they will be an active player in this space, and they're targeting that. These take time. Each loan, each grant is pretty bespoke. So it's not like we're going to see a flood of these immediately, and it will take some time to roll out. But I want to turn it over to David and let him speak to the specifics of MP.
Great. Hi, David.
Hey, good to see you.
Yeah, nice to see you. You definitely want to talk about equities and things under your coverage. It
Sure.
was huge news day, and we received your notes and upgrades, on MP. But that deal looked extremely sophisticated, and Jim Latinsky commented that this was like a really tough negotiation with the Department of Defense, akin to the hardest, private equity style negotiations he ever would have undertaken. And I joked in my Lithium Bull that, the deal was structured as if, the Commerce Secretary, headed an investment bank, and was a SPAC underwriter.
Imagine that. Yeah. That's right. Look, I would hope that the negotiations were challenging, because he succeeded in extracting billions of dollars of taxpayer dollars for an equity investment, right? So fairly unprecedented.
Yeah, but it was only $400 million equity investment. And now I want to compare that. Is that compares to a $2.23 billion loan at, U.S. Treasury rates for Lithium Americas. So what's a better way to finance critical minerals investment? Having shared risk with upside to the taxpayer,
Right.
or, the LPO type loans?
Well, I think that there's another part in there that I think we need to clarify, right? Is yeah, they received the preferred equity investment which is akin to receiving the 2.2 billion dollar and change loan from the DOE. However, the DOE has no upside with Lithium Americas, and the offtake, is more or less fully guaranteed or fully subscribed to by General Motors, right? So, in the case of MP, the government has the offtake for 7,000 tons a year of magnets. But I think what's interesting is it's not just the 400 million up front, right? It's also billions of dollars of the arbitrage of providing $110 a kilogram floor for NdPr oxide versus prevailing market prices of close to 60. That's coming at the expense of the U.S. taxpayer. And then the upside is the equity earnings, not just on the warrants that they have that are logically already in the money, and the preferred investment that they have, but it would also be the cash flow upside for one, any pricing above $110 a kilo for the content in the future. But then we don't know what they're going to do on the magnet side. And I think it would be pretty interesting to have the DoD as a partner signing offtake agreements, with defense contractors and the like for 7,000 tons a year of magnets. And that's where I think there's a pretty interesting, compelling cash flow upside. And if this model, I can't imagine that this model is a blueprint for everything, but it's far more compelling for an equity than just receiving a loan. The DOE rather, right? Like Jigar Shah always said, they're not in the business of giving grants. They want their money back. This is you're getting your money back, and you're retaining quite a bit of operational and financial upside.
Yeah, I think it's a better method, right? Because again, it's a public-private partnership, and Jigar Shah kind of talked about him providing bridge to bankability, right? He was filling a gap where the commercial lenders would not fill, right? In this case, MP is getting $1 billion loans, from J.P. Morgan and Goldman Sachs, which was facilitated by the predictability of the earnings stream from those price floors, right?
Right.
So I think it's a much more sophisticated structure. It's clearly had a much better impact to the stock than we've always said, kind of like secured debt kills equity. So right, like having a 70% debt, but Lithium Americas is a greenfield, and MP is already producing, but a lot of this money is to grow magnets, which they're not, which is greenfield, which they're not yet doing.
Well, there's also
So like
100%. There's also a greenfield element, which is ramping the refining capacity to full capacity, which to date has only produced at roughly a third of nameplate, and we can get into why. And there are many reasons why, and it's not necessarily operational issues, but there is a greenfield element of MP needs to take this stage 2 NdPr separation facility up to over 6,000 tons a year of NdPr oxide, or else this entire dream of making 10,000 tons a year of magnets doesn't exist.
Mm-hmm. Okay, so you said, John, that there's $7.5 billion, at the Department of Defense, so they could write, a bunch more of these $400 million checks. The DOE had, I don't know, 440 billion, right? So we thought that they could write a lot more of these, $2.23 billion checks. But do you see, David, like I've made some comparisons. I did a ChatGPT, after rare earths, what is the Defense Department most other metal most concerned about, right? And I asked them for like the top 10, and like antimony and tungsten, and graphite were listed among those, but the number one was lithium.
Yeah.
So then I thought, like, okay, what might they do in lithium? Like, might Ioneer, rejigger their Jigar Shah loan, into a Defense Department, strategic partnership, because they are looking for a strategic partner, right? Or might Albemarle's Kings Mountain past producing mine be seen like Mountain Pass's past producing mine? And might they revive their, Carolina 100,000 ton mega megaplex facility and basically say, hey, we're not going to invest in that unless lithium hydroxide or carbonate, is 20,000.
Yeah.
Well, 20,000 is not that much higher, or it's about the same ballpark as the NdPr at 110, versus 60.
Right.
So I'm talking about this. I'm speculating about
Except
this.
for the fact that
You
$20,000 a ton lithium hydroxide is not an incentive price, right, for exploring lithium hydroxide production in this country. I think you have
well,
to
I
be
mean,
out there guaranteeing.
Albemarle said that's the price that they would need to like make an FID. I think on the megaplex. You don't think that's high
I
enough?
think that's the margins would be extremely meager at $20,000 a ton, right?
Really? Okay.
I also
So
think like the important contrast here, right, is that Mountain Pass was already producing rare earths 42,000 tons a year at capacity, right? That was almost 8% of global supply. We don't have an incumbent mine like that here on the lithium side, and I think that it's harder, I think, for the DoD to come in and bring equity firepower to a project that's not producing at all on the upstream side. I think it might be a bit different if if Thacker Pass was producing 40,000 tons a year, or if Kings Mountain was up doing 500,000 tons of spodumene concentrate a year, it would be a little bit different. But I think just given the fact that you're still several years out from any upstream production in the U.S. of remote scale, it would be really difficult to come in right now with that sort of equity assistance.
okay. So do you think this was unique because it was in production, and it's unique because rare earths are unique? We're more beholden to China than let's say lithium. I mean, because what they are financing. I mean, what was the 400 million preferred equity? That was partially to, to grow a brownfield, a greenfield magnet.
Yeah.
I guess the price floor, again, it was very sophisticated. There was a lot of moving parts to it, but there is a greenfield component to it.
Yep.
On the magnet side.
Yep.
So why, if they're going to finance a greenfield in magnets, why wouldn't they finance a greenfield in lithium hydroxide?
Well, what they're doing really is they are incentivizing them to produce as much NdPr oxide as possible through any means possible, right? Any means necessary. Like putting in $110 a kilo as a price floor. I think MP outlined in their presentation at the time that this puts a guaranteed floor on stated nameplate of 450 million of EBITDA a year. So it means that if you're capable of getting beyond 6,000 tons a year or 6,075 tons a year, if you can produce more, you're obviously achieving EBITDA upside. They also remarked that the floor for EBITDA margin on magnet content was approximately 150 million for 7,000 tons incremental of magnets. They were going to produce 3,000 tons at this Independence facility that they had already built, which to date had only been scaled for 1,000 tons a year, and that was directed at GM, or directed for GM. And now, subsequent to that, Apple has come in and effectively sold out the rest of Independence with 2,000 tons a year. So what they're doing, right, is incentivizing them to start producing the upstream side and a refined product. And I think it was unique in that, look, China controls effectively all of that market. You do obviously have a Japanese and Korean magnet making industry. Lynas supplies most of the content to those markets, and outside of that, there's nowhere else to go. So I think it was more in this case, lithium. There are other places to shop around, especially to satisfy what the Department of Defense needs. And I think in this case, this was squarely, I think, a move to increase the oxide production here and have optionality on magnets, because there's other companies out there that can make magnets.
I think, thanks for that. But I think rare earths were the Achilles heel in the Trump, the U.S.-China trade negotiations.
Yep.
So I think there was extra urgency, on that. Lithium does not have that same Achilles heel component. But I just want to dig in more. I'm mindful of your time, David. It is earnings season, and we only have about 15, 20 minutes here. So I want to go through some of your coverage,
Yep.
but I do want to dig in a little bit more, on rare earths. With the DoD's backing, do you think MP now has carte blanche to go out and be an acquirer, consolidator of overseas rare earth projects and assets?
I don't know if it's carte blanche, but it's like maybe carte off blanche or something. But the look, they're still finalizing the terms of that deal. Does the DoD intends to support financial market arbitrage and cross border public market arbitrage by providing a floor? Perhaps not. The DoD, it's also, when you think about ultimately what they're going to achieve with this build out of up to 10,000 tons, you're certainly satisfying all of the imported content that we have as a country on the magnet side. And maybe you're satisfying between 25 and 30% of the overall market for magnets in embedded content. So how much further do they really need to go? That's up in the air. There also, there aren't that many third-party producers to go out there and acquire. There's obviously Linus in Australia that produces out of Malaysia, and I think that it's conceptually that could be an acquisition target for sure. If the $110 a kilo floor could be used as an arbitrage tactic, but that's very much, I think, going to be in the finer print of ultimately how this deal gets finalized.
Yeah, maybe if I could just
Okay.
jump in a point on that too as well. I think that one of the attractions and possible unicorn nature of MP is not only its corporate structure in the US, but its assets being in the US, right? And so like having the ability to go out and expand and scale outside the US is probably beyond the bubble of what was the initial attraction for this defense-led investment in the name, right? And so that kind of creates some challenges for other larger integrated miners who maybe have attractive assets or projects, but have a global footprint, have incorporation structures, management outside of the US. And so those investments would likely have to be more project specific from DoD as opposed to corporate-wide equity style or warrant style investment in the firm. So I understand the expansion of it, but I think that's one of the things that's going to have to really be understood in what the terms of the deal are, as David outlined, and it would potentially change the attraction of a company from the perspective of the Trump administration.
Oh, appreciate that, but I think to make magnets, you also need the heavy rare earths,
Yes.
David,
Yep.
and so MP does not have all of those.
Yep.
And the Department of Defense, there are international arms like the DFC that have financed things like in Mozambique and graphite and elsewhere. So I mean, you can have interagency kind of collaboration, to solve these. So what do you think, David, MP will do to source heavy rare earths?
I think there's, one of the things we didn't discuss is this going to be, I think, a multi-part solution. But first is this deal with Apple, right? Apple entered a $500 million offtake agreement, which included a $200 million prepay that is going to effectively consume 2,000 tons a year of magnets out of this Independence facility. But it stipulates that those magnets must be made from recycled content. And this was a collaboration that apparently has been going on for 5 years between the two companies, MP and Apple. So this is building out a new capability of recycled content. And as you can imagine, if you're recycling spent magnets or magnets and spent consumer electronics, you're also going to be recovering heavies out of that. You're going to be producing more NdPr oxide that you've separated out of the magnet through recycling, and you're also going to be recovering heavies. So I think that's going to be part of the solution is recycled material. And to date, company reports in a couple of weeks, we don't know what their ultimate plans are for recycled content, if it's going to be beyond the scope of the Apple agreement. But I think that it is a very interesting expansionary opportunity for upstream content. And then beyond that, they are building out a heavy rare earth separation facility. There is trace heavy rare earth content at Mountain Pass, but I think there is also an intention to take third-party feed. And similar to lithium, you can find it everywhere. And if you're incentivized, like there are stockpiles, ionic clays, there's other mineral sands out there. There's, I think, various sources of third-party feed that would have heavies content. Perhaps not with perfect concentration, but if you're getting this attractive supplement, there are solutions to this problem. And keep in mind, right? Yes, you do need heavies, but you do not need a lot of them.
Okay. Okay. Thanks. We're just getting up to speed on rare earths.
Yep.
A new colleague of ours, Matt Fernley, knows them, deeply, but we're going to be covering a lot more, in rare earths. But so I want to spend the rest of the time, talking about your lithium coverage, the lithium bid we got, but also just kind of making this comparison to, rare earths. Like a lot of rare earth stocks have gone up, right? Even though this has been specifically good for MP,
Right.
but rare earths prices have not really gone up. So
Yeah.
why should, if commodity equities follow commodity prices, why should other rare earth stocks, go up? And here in lithium, you actually have seen, lithium prices starting to get a rise, in the last little while. But a lot of the demand story, I mean, a lot of MP is talking about, yeah, but NdPr prices will hopefully be higher than 110, more than double, in a few years because of the advent of robotics and all the like. But so it's like robots are to rare earths what like EVs were to lithium, right? But it still seems like relatively far, in the future. I don't, if you can help us think about, comparing like rare earths and the dynamic there, to the lithium dynamic. And there's a broader, sentiment shift here. And then if we can kind of talk about, your coverage, I think you cover Lithium Americas, Lithium Argentina,
Yeah.
Piedmont,
Yeah.
Lithium Royalty Corp,
Yeah.
Albemarle,
Yeah.
and what you're thinking about all of those,
Sure.
because I know you've not been super bullish.
Yeah. Yeah. I guess a couple of things. You think about the stocks, like one, since really like Liberation Day, April 2nd, I think that there's been like a supply chain trade, right? So there's been a bit of this Trump trade anyway, I think, going on that kind of put a compelling undercurrent under a lot of different material stocks. Rare earths, I think the difference right now, it reminds me very much in many ways of lithium, maybe coming out of COVID, where there was this scramble kind of inefficiently in China for content that just wasn't there. And we saw the price go, north of $80,000 a ton, right? And that was a fun time. I'm sure you like to recollect those times, as do I. But for like nostalgia aside, right now I think that there is a little bit of this shadow supply chain freakout dynamic going on, where we saw Ford and some others, Stellantis, kind of raising the flag of, they're not getting deliveries of magnets. This is a problem. You have seen the price of NdPr recover from about $50 and change per kilo to a little over 60. But again, it's the supply chain is so sensitive right now, with not necessarily like demand going gangbusters. There is no step change function in demand. I think this is just more the market trying to solve for a huge supply chain impediment. And then rightly so, right? You've seen other rare earths companies. There aren't that many out there in the public investment sphere. But I think obviously for the ones in the United States, every management team right now, right, has their hand up trying to build analogs to themselves in MP. That's easy to do. I don't think that this $110 a kilo price is going to be extended to the entire industry, or that they would be signing up agreements like left and right. Linus has logically benefited because, look, if you have one major player now in play with enhanced economics, then it can rise the tide for all boats because they can do acquisitions. And then, I think there's also the belief for sure that other countries will recognize what the U.S. is doing and also want to perhaps build out their own incentivized supply chains and perhaps see a price that divorces from China. If you contrast that with lithium, the dream, right, was always that North American lithium pricing was going to be at a premium to China or global or really anywhere. And we have not seen that happen, right? And obviously the demand center, particularly around the electric vehicles in this country, has been pushed out half a decade from our original reference case, right? Um, so I think it's more right now, there isn't a supply chain freak out where people can't get their hands on lithium. The difference is like when you're transacting at $8,000 a ton, no one is making money on the lithium carbonate side, right? And you think about, uh, I think anytime you are materially below a incentive cost curve for just maintaining production, it is a very dangerous place to be short, and you have to be betting that China is going to continue flooding the market apace, right? And so I think it's easy for lithium to have caught a bid, and now it's like, we've rallied up to $10,000 a ton, and everyone's high-fiving themselves, and I'm like, $10,000 a ton is still abysmally low from a cyclical basis, and no one is making money at $10,000 a ton. So, I think we remarked recently like 25% of incumbent producers ex-China are operating at operational losses right now, right? So we still have a ways to go, I think, before the public industry is, quote, healthy. But we've obviously caught some enthusiasm, I think, on reports that some folks are going to be curtailing volumes in China. And look, honestly, it's like, I think we've all seen this movie before, where we hear reports of either environmental regulations or enforced shutdowns, and none of this has appeared to be price sensitive at this point. And then magically things end up back online within a month, and we've misconstrued the entire message. So I'm not necessarily going to get on the hope train at this point, because I think that the market is still structurally oversupplied. But if somehow you can put a curtailment thesis in play for 26, like by reference, I think we're modeling about a 5 to 6% oversupply globally next year. And China is a big part of that, clearly. So if somehow that moderated, then maybe you could see things moving towards what we think is a long-term incentive price, still in the $15,000 to $16,000 a ton range, which I think many of the lithium equities are already starting to discount. But I think the difference is many of these names are not. You look at bellwether names like Albemarle, right? They've cut capital significantly. Even at $10,000 reference case, they're approximately free cash neutral. In 25, there is no growth in the model anymore. But if you think about worst case scenarios, absent some sort of execution issue that we're not foreseeing, the balance sheet isn't imperiled, and nor is the company. So if you're a long-term investor, you can certainly wait for that kind of reversionary move. I think our issue has been, we don't think that the market fundamentally improves until really 2028 or 29. And I accept the fact that that is a consensus view. And because everyone is short the group, you're logically going to see a proclivity for bounces like we've seen over the last month or two.
Okay, we're starting to get a lot more inbound, interest in lithium. Or are you hearing the same, like from your investors?
Yeah, people love to do work after something goes up 100%. I get more calls on MP after the DoD thing, sent things up 100%, and the next 100% is always harder than the first one. So, but I think people.
So are you getting inbound for lithium, or are you getting inbound
I'm just
for
using
MP?
it as an analog, but I think in general, look, coming from a base case of zero interest 6 months ago to now, yes, there is incremental interest in lithium. Okay,
it doesn't sound like there's a lot.
It's not a lot.
That's good. That's good. That's a contrarian indicator, because there is an argument that when lithium was on TV every day, that was the time to sell.
Yeah.
And lithium's not on the TV every day, but other commodities are on the TV every day.
Yeah.
So there seems to be a lot of short covering, happening.
Yeah. No, yeah.
So whether or not that's sustained, do you feel that is the case?
I think it's we're sort of back to, like, it's funny because you look at some of these names and the equities are back when, at levels where they were when lithium pricing was $15,000 a ton on the carbonate side. Do I think we're going back to that direction? I don't think so. I hope for your audience perhaps that we are, but that's not in my forecast. And I think this is going to be short lived. But I also think when you get dangerously below the cost curve, with spot pricing, you're playing with fire on the short side. And to your point, look, Albemarle I think was the second most shorted name in the S&P 500, and plenty of others like Lithium was on the lowest end of most people's favorability list, right? So these were very crowded shorts. And any move in the commodity is going to trigger that short covering. And you've also seen short covering in the commodity itself and in the futures market in China, right? So, typically that's not something that's sustainable unless you actually do see one of the things that I've been looking for is a curtailment of ex-Chinese supply, which we have not seen. And I think that would provide more confidence to the broader lithium market. But I think most investors still have an issue of China seems to grow at will, agnostic to price, and the Australians are still growing, and I have trouble picking a winner in that environment. So,
okay, I hear you. So you're still in the kind of consensus bear camp, even though 5 to 6% oversupply, which you're forecasting, is not that large, right? That can swing relatively quickly, because we've seen that in the past. But Goldman just had a note out, which Matt and Rodney kind of like refuted. We're suggesting like a 50% oversupply. I think in the next year or two. Okay, so on balance, you're not bullish. Lithium, you're not pushing the names.
Sounds like I'm at least less bearish than Goldman. 50% is
right. Yeah, okay, that's an extreme bear. Could you I guess you cover, I think your top picks, Lithium Argentina, is that right?
Yep.
And what do you think about the Piedmont merger with Sayona, Lithium Royalty Corp? If you just kind of run through your thoughts on your coverage.
Yeah, sure. Look, we think Lithium Argentina is just very well capitalized, right? They have, you're looking at operating costs. Like obviously any brine project that's online is going to be making money in most environments. And they obviously have an attractive benefactor with Ganfeng that I think is still going to be looking for more feedstock over time. And I think there is a logical combination at some point down the line. So we think that, particularly as you think about the broader regional development plan and including projects like Pozuelos and Pasos Grande, there's quite a bit of organic upstream growth opportunity. Attractive balance sheet, a privileged, sort of financing relationship, and one that tends to kind of just fly under the radars. And at the heart of it, you do have an asset that is highly cost competitive with most of the world-class assets out there. So I think this is very much one of the long-term consolidation stories, and in the interim, just becomes, I think, a relatively safe place to participate in growth of a project when you kind of consider many peers that are completely incapable of growing right now. And certainly, look, Piedmont and Sayona, you'll close, and Alevra, I think, is going to start trading sometime in September, when Sayona shares are retired. And I think it'll be fascinating to see what happens, certainly up at NAL. But I think for now, like our view, I mean the pro forma company becomes better capitalized, but it's still an asset that obviously is going to struggle where spodumene prices are right now.
Right. Okay. And Lithium Royalty Corp, you mentioned like Argentina. I've recently, thought, Lithium Royalty Corp has two Argentine Chinese connected, assets, Trey Q and Mariana, which are meant to kind of come online, as a revenue producing, as a way to play Argentine brine now that Arcadium's gone and like Orocobre and Livent, we're gone. There's been a dearth of way to play producing Argentine brines. Like Lithium Royalty Corp, I've thought, now has that. Plus they have Sigma, as a producing asset. So what are your thoughts? I know you're one of the few analysts who cover Lithium Royalty Corp.
Yeah. It's, I think I think we're probably at a point now where Lithium Royalty Corp has an immense inventory of projects, right? You feel like if you cover Lithium Royalty Corp, you effectively cover what feels like the entire lithium universe of projects, because they do have fractional interest in many. But you think about now, like, yeah, they have several projects that are coming online. They're very limited in terms of revenue generation right now, where you really only have Sigma as a significant producer of revenue right now, as other projects like Mount Cattlin, Finnis have winded down. But you will have obviously Mariana and 3Q perhaps before the end of this year. And then certainly as you get into next year, you'll have more projects. I think that the fear around LIRC for a while was that you'd see more project delays and cancellations. I would think that fear has probably peaked. But the reference point for real cash flow inflection, which is attractive for royalty names, is you're still a couple of years away there. But we do think that it's undervalued where it's trading today, and still see upside to about $7 Canadian a share.
Okay. David, it's 10 o'clock. I know you have a hard stop there, but if you can answer, I guess just two related questions, the Trump-Elon dynamic and the Trump-China trade dynamic. I mean, do you see, a grand bargain potentially happening, in a Trump trade deal? And what is, like, how do you make, the bromance and the breakup, between Trump and Elon, and how that might impact, lithium equities, battery, supply chain commodities?
Yeah, it's difficult to say on the. Look, I think at this point, you look at like year-to-date EV sales in the U.S. and Europe, like a couple percent, right? I don't think that dynamic is changing very much anytime soon, because the EV tax credit's gone, and in some cases, like, I feel like incrementally we're back to like EVs being sort of a luxury vehicle, and you're still going to have price parity issues in this country. The headlines of this Elon, Trump bromance, I'm not sure that I have very much to add. That's a little bit out of my wheelhouse, but I think it's just, if you follow the fundamentals, EV manufacturing is clearly slowing in this country, and that's not going to be a dynamic that's helping it anytime soon. And rightly, Rodney and your team has pointed it out before, right? The green shoots right now that I think are interesting but are much harder to track are the energy storage markets that are, nearly adding as much incremental demand as EVs are right now, and should eclipse that in a couple of years.
And that was a bright spot in the Tesla earnings call yesterday. Although some people are saying it's a bright spot because his XAI, his own companies, are the purchasers of a lot of those batteries.
Yeah.
Okay, I'll let you go, David. John, do you want to opine maybe on the politics of Elon and Trump, and the politics of Trump vis-a-vis China, now that we have a Japan trade deal, EU hopefully coming up? What do you think?
I mean, like, so and I think framing this from principles and high level is the best place to situate, because there's probably an unending flow of micro details that we're just never going to be privy to. So, I mean, the connection between Elon Musk and Donald Trump always felt very transactional, very combustible. We did see that, and we were, broadly speaking, sellers of the Doge concept heading into this new administration, specifically with Elon Musk at the head of it. If you remember, it was initially meant to be a dual head with Elon Musk and Vivek Ramaswamy. Ramaswamy didn't even actually make it to Inauguration Day. And then clearly, Musk just ran into a number of institutional challenges. The takeaway from this is, as Doge becomes more institutionalized now with an OMB run by Russ Vought, it's actually going to probably become more effective than it was. Certainly less headlines, but probably more effective. Bigger questions on this are, does Elon Musk have the capacity and interest in actually self-financing a new third party, which he's discussed? What would that mean for the MAGA base? What would that mean for Trump followers going forward? We'll know more about this into next year, right? So while we might not know right now what the key debates are into the midterm elections in 2026, the cast of characters, right, who will be on those ballots, we will know that soon, really December 1st for most of these elections, both Senate and House coming up. There's requirements to be fully vetted in the system if for to be ready for primary structure. So we'll see how he chooses to deploy in that space. There's a lot of business issues that Elon can of course focus on, right? If he wants to and go down in that direction. So we'll see how that plays out. I mean, right now, I'm actually pretty surprised that maybe the Trump administration hasn't tried to restart its feud with Elon Musk. It would be a great distraction from some other issues right now that they're not looking to talk about. So, they're really trying to just throw out anything in the world right now, throw it up against the wall and see how we can move forward on this issue. So maybe that's one that they decide to do or choose not to. Um, on China, yeah, look, this administration has claimed a lot, and we've not seen a lot when it comes to trade. So I'm very cautious on even the framework that's come forward on Japan. You speak to serious trade individuals here in DC, and their view is until we see a deal in the Federal Register or something moving towards Congress, there's nothing really been done, right? So we can think back till July 3rd, July 4th when we had a deal with Vietnam. It's now the 24th. We've seen no official details of that actual agreement, if there is an agreement. So the administration can be a little bit promotional with this, like what they term as a deal could be as broad as principles leading to a framework which might lead to something on paper. So in China in particular, it's worth paying attention to that, right? We had this round in Geneva, the Geneva Consensus. Don't really fully know exactly where the four corners of that were. It was pushed forward in this London meeting. They could very easily continue to kick this can down the road for a while. August 1st, August 13th, 14th are kind of these deadlines that are now being kicked forward by the administration. We kind of just have to see. This administration is kind of all about the headline, and then the details and filling in the process behind it can sometimes take some time and sometimes never actually come together. So what does Trump really want here? We're trying to figure that out. I think China's trying to figure that out too as well. What would the administration be willing to trade as part of an agreement? Be it technology sales, be it defense sales, be it recognition or non-recognition of certain countries around the world. A lot of these issues are certainly on the table. The things that we do know the administration is really focused on is that the deficit on goods, right? The trade good deficit, right? So that's a number that they want to see impacted either by reciprocal tariffs, as they call them, or by direct purchases. So agriculture, commodities, and maybe technology are places to watch if there are four corners of a China deal. But timelines, yeah, it's really hard.
How would you thank you for all of that. How would you handicap, probability wise that, there could be, you know, Trump welcoming a battery plant investment from CATL, right? Or an EV manufacturing from BYD or some other companies?
Yeah, it's certainly not impossible. It's not an impossible outcome, but right now we're not there yet, right? We're still the directionality and signaling you're still hearing from the White House directly towards Congress is to be very strident, right? And we saw that in the reworked foreign entity concern language. We see that basically on a daily, weekly basis from the standing the select committee on the People's Republic of China in the House, and the press releases they're pushing out, the conversation they're having on defense industrial base, critical minerals, battery manufacturing, sort of naming and shaming those companies you just mentioned. So for right now, the messaging and the politics is still strident anti. That could change as part of a deal, but right now we haven't seen any of that signaling. One of the interesting comments we did see was Ford was pretty quick to note that they believe that their Blue Oval facility in Michigan, which uses that CATL IP licensing structure, would continue to function and be viable under the new One Big Beautiful Bill 45X. So, maybe that's an area where we could see this. It's much more of a soft, yes, CATL is not going to build the facility, but a Tesla or a Ford or maybe even a Stellantis, something of that nature, can license it and move forward with the technology.
Okay. I just final question. When do you think for me, the China deal is like the big deal. He wants to kind of get the other deals out of the way before China. So when do you think it like really heats up? And he also needed to get the big, beautiful battery bill done so that he could, extend his tax cuts, et cetera. So he's knocking down a bunch of pins. what's the time frame where you think, that China, he meets with Xi Jinping, Xi Jinping kind of comes here, and these deals are hashed out in earnest?
Yeah, I think that there's been a lot of learnings in Trump 2.0 for versus Trump 1.0, right? I know you're focusing specifically on China here, but I mean, you can look at leadership in Canada, Mexico, who are particularly infuriated that they invested and built the USMCA. And then this administration in Trump 2.0 almost immediately began tearing up that process. It's the same thing on the China side, right? It's the same principles on the Chinese side engaging in this conversation. So I would not discount the wait Trump out narrative, right? Here in the US, it's like, oh, we're in the first 6 months. We've got 3.5 more years of Trump and the administration and the political ethos. I would not be surprised if there's more from the Chinese side of which we're just going to wait this guy out, right? Let's just drag this off. There's no reason to come to a deal. The reporting that we receive that we like is that Trump is becoming frustrated that Chinese entities and individuals aren't coming to the U.S. that don't want to engage in his phone calls, that don't want to play this game that he's been doing, where it's throw out a concept, renegotiate, renegotiate, renegotiate. So there's a world where there isn't a deal, right? It just doesn't happen. Then the rest of the world, on a bilateral basis, is stuck in this paradigm of, are we going to attack more towards China, attack more towards the US, maybe attack towards the European Union if possible? Another paradigm shift that's happened to as well, and it's kind of kicked off really since Liberation Day, where if you were in Indonesia, Vietnam, Malaysia, the Philippines, there was a first mover advantage to get that deal with the US. It kind of feels like that's now flipped, where I'd rather be kind of towards the back of the pack, where I can see where everybody else already got, either from a rate perspective or a carve out on the TRQ side, and then I can make sure I get something at least as good as that. So the push from this administration is now bouncing against a pull from other administrations. I know it's not a specific answer to your question. I mean, there are a bunch of catalysts, right? There's always the G20 meetings that come up. Those are interesting catalysts where leadership gets together. The G7 meetings. There'll be the midterm elections, so they might want to show some progress before that. Those could be catalyst dates, but other than that, it's kind of on their timeline.
Sounds good. Thank you very much
Sure.
for this kind of real-time assessment, John.
Of
I
course.
was curious to talk to you like earlier this year, but I just said with all the sausage making with the big beautiful bill, I wanted to see that dust settle. But even it never settles, right? There's
Yep.
guidance,
Yep.
consideration, interpretation. There's all sorts of other uncertainties out there. But thank you
Of
again
course.
for coming on and giving us this update.
Sure.
And
Appreciate
with
it. Thanks so
that,
much.
enjoy the rest of your week and weekend and summer, and look forward to re-engaging in a couple of months.
Yep. Sounds good. Thanks, Howard. Appreciate it. Thanks for having me on.
Okay. Take care, John.